Hello, everyone, and welcome to this Center for European Reform webinar. We are here in Berlin, and Isabel Schnabel is also in Berlin. So we actually happen to be in the same room. So this is CER's return to physical events, at least as the speaker and the chair is concerned. And we are very grateful that Isabel took the time on her Berlin visit to visit us. There's not that much introduction needed, I think. Isabel Schnabel is a member of the executive board at the European Central Bank, a former member of the highly influential German Council of Economic Experts, and a professor of economics at the University of Bonn. We will have a round of 1 hour webinar, which gives us the opportunity first to listen to what Isabel has to say for about 15 minutes, together with a set of slides. And after that, we have 45 minutes or so for discussion. If you want to say something, we absolutely encourage you to do. Please raise your hand electronically in Zoom or write into the chat function that you want to say something. And I will call your name and you will be unmuted by our team. Just as a reminder, this session will be recorded and will be on the CER's YouTube channel later to watch again. That shouldn't prevent you from asking questions. Don't be shy. There's a lot for all of us to gain from a lively discussion. And with that, I would like to hand over to Isabel and the interaction of monetary and fiscal policy in the eurozone. Thank you.
Thank you very, very much, Christian. So it's a pleasure to be here at the Center for European Reform. So now I will try to share my screen. I hope it works. So that looks pretty good. Is there anything else I have to do? No. Okay, so let me see. That doesn't work. Oh, now it works. Excellent. Thanks again for the invitation. I'm going to talk about fiscal dominance today, which of course is a very important and highly disputed topic. So as you know, the euro has of course been built on the principle of monetary dominance. And what this means is that the ECB conducts its monetary policy objectives as defined by its mandate in the treaties without actually being constrained by other considerations. And in order to buttress this principle, the ECB was given a high degree of statutory independence, and we also have a very clear mandate. And I think it's fair to say that the ECB is one of the world's most independent central banks. And at the time of the Maastricht Treaty, high government debt was actually seen as a major threat to central bank independence. And it was feared that fiscal dominance could induce the central bank to deviate from its monetary policy objectives, which of course would then endanger price stability. And if we look at history, we see there are quite a few examples where high government debt was actually resolved through higher inflation and financial repression. So you could also say that the Stability and Growth Pact was meant to shield the ECB from fiscal dominance and therefore to protect its independence. And so what we've now seen in the past years is that, and I guess I should switch to my first slide, that government debt has been rising in many countries, and this has led to a new discussion about the role that monetary dominance still plays, or whether there is a threat to monetary dominance, so that we are moving into a regime of fiscal dominance. So let us have a look at the numbers. So what you see on the left-hand side graph, and these are numbers from the IMF, the government gross debt in advanced economies increased from 71% of GDP in 2007 to 105% last year, and is projected to increase to 132% by the end of next year. So that is the red curve. So if you compare that with the euro area, you can see a similar increase from 66% in 2007 to 84% last year, and the projection is in the range of 100%. Of course, it's important to note that this is still well below the average level of advanced economies. But of course, given that the average is at 100%, it's clear that some countries may be above and others below. And the right-hand chart shows you that there's actually quite a bit of heterogeneity within the euro area. And there are quite a few countries where public debt will increase to levels well above 100%. Rising indebtedness implies that governments will need to roll over increasing amounts of debt, and this comes on top of the need to finance the newly issued debt. And so this graph shows you ECB staff estimates of the gross financing needs of euro area countries, and you can see that this year the gross financing needs reach 24% of GDP. And what's also interesting is that actually it's expected to remain elevated for quite some time. And if you compare that with the time after the global financial crisis, it's actually even longer. The newly launched European Recovery Fund has helped alleviate some concerns about the impact of the pandemic on sovereign debt levels in those countries that were hit most by the crisis, which also tend to be those with the highest public debt levels to begin with. But of course, the European Recovery Fund does not mean that, that we are in a fiscal union. And even if we were in a fiscal union, there would still be the question whether the rising debt has jeopardized or will jeopardize monetary dominance, and then as a result also central bank independence. And as you all know, there is quite some discussion also about the ECB's purchase programs, and some accuse us of monetizing sovereign debt at the expense of our primary mandate of price stability. There's also the argument that the ECB's policies are undermining fiscal discipline because we are holding interest rates artificially low. And finally, there's also this discussion about the deviations from the capital key under the PEP, which are sometimes interpreted as that we are tailoring our monetary policy towards the most highly indebted euro area countries in order to ease their debt burden. And of course, this whole discussion is not entirely new. So there was a discussion about central bank independence already before the crisis. So in my remarks today, I would like to talk about three different aspects of this very broad topic. So the first part will deal with the misconception that the ECB's policies constitute a form of financial repression. The second part will then talk about the disciplinary function of sovereign bond markets and whether markets actually still play this function in spite of our asset purchases. And in the third part, I will then talk about the changed interrelationship between fiscal and monetary policy in a low interest rate environment. But let me start with financial repression. So what do I mean by that? So typically financial repression is used for all types of policy measures that aim at keeping interest rates artificially low, which then makes it easier for governments to finance their debt. And of course, these measures can take very different forms. It can be capital controls, interest rate limits. However, more recently, this term has predominantly been used with respect to central bank policies, including asset purchases and negative rates. And again, if we look at history, we see that times of financial repression typically then were also times where private investment was low, growth was low, and employment was also low. However, if we look now what happened since the start of our asset purchases or our public sector asset purchases in 2015, we see that actually the opposite has been true for the euro area. So according to ECB staff estimates, the real GDP growth would have been around 1.4 percentage points lower if we had not taken these actions, so if we had not purchased sovereign bonds. That of course then also implies that that in the absence of our measure, the public debt ratio would actually have been notably higher. And this is what you can see in the left-hand graph. So you see the blue curve. So this is the actual evolution of the public debt ratios. And then you see two types of counterfactuals. So there's one that only takes out the interest rate impact, and the other also takes out the effects on growth and inflation. And I think there's one very important thing about this graph. What you can see is that the major point of the purchases was coming, so the major effect on the public debt ratio was coming through economic growth and not through interest rate expenses. Of course, it is important to emphasize, and we always emphasize that our monetary policy is guided by our mandate, and our mandate is price stability, and it's not guided by the wish to lower the public debt burden. And in fact, there is no evidence of a feedback loop from sovereign debt developments to monetary policy decisions. And the graph on the right-hand side is one type of evidence that you can look at. So what this does is it considers the government bond issuance and our purchases. And what you can see there is that there's actually no systematic relationship between the government bond issuance and the amount of bonds that we purchase in the secondary market. So in fact, what we're doing is that we aim to deliver the financial conditions that are needed in order to obtain our inflation aim in the medium term. And of course, this is affected by sovereign bond issuance, but this is only one among many other factors. And so basically we are reacting to any factor that has an impact on financial conditions and therefore poses a threat to price stability. So a second piece of evidence that I would like to give you is based on Taylor-type rules. So I'm not a particular fan of Taylor-type policy rules because they are, of course, a bit blunt. But I think in this context, they're actually quite useful. So what we have done here is, so we have estimated Taylor rules on the basis of data before the global financial crisis, and then we compare actual policy rates and these so-called shadow rates, which also take into account the unconventional measures. And so we compare these rates with the Taylor rules. And what you can see is that they are actually not so far away. And you could have expected that as we know, after the global financial crisis, sovereign debt actually went up quite substantially. And you could have expected that this leads to a break in the ECB's reaction function. And so in this graph, we don't see any of that. And then if you simply add government debt as an additional feedback variable in these Taylor rules, and this is shown on the right-hand side, you find actually that these coefficients are generally not statistically different from zero. And then, of course, and maybe this is the most convincing evidence, is that under fiscal dominance, which basically means that the central bank is constrained by other consideration in its ability to obtain price stability, one would expect that medium to long-term inflation expectations should rise sharply. And the reason is that the public expects the central bank to monetize debt. And this was, of course, the case in the 1970s. That was a time when there was much more political interference in monetary policy, and central banks were not yet granted full independence. However, if we look at inflation expectations today, be it market-based expectations or survey-based expectations, there is no evidence that people expect inflation to accelerate. And of course, we have seen some recovery from the historically low levels, but inflation rates remain well below the levels that we would consider consistent with our medium-term aim of below but close to 2%. So if anything, there's an issue of too low inflation rather than too high inflation. So the second argument I would like to make is that markets have not lost their disciplinary function due to the ECB's asset purchases. So, so one first piece of evidence is that you simply look at sovereign bond spreads, and one sees easily that the risk premia in euro area sovereign bond markets have not disappeared. And so, for example, if you look at the 10-year sovereign bond spread on Italian government bonds over the German Bund, you can see that these are, even after all these asset purchases that we've done, they're higher than at the time when the ECB started to purchase government bonds. Of course, many things have happened in the meantime, but this is a first indication, at least that the risk premia are not gone. And what we also see is that idiosyncratic news matter. So look again at the Italian graph, which is the light blue graph. And I think it's very interesting to see how the Italian bond spread shot up in 2018 in response to the episode of political instability in Italy, which, by the way, was not countered by monetary policy. And there you see that there is actually some disciplinary role that is played by financial markets. And then if you look at the other curve, which is Portugal, you see that those spreads have decreased quite dramatically, but it's very easy to link that to economic fundamentals. So the time period that is shown here, where this decrease was taking place, was a time when Portugal turned from a relatively high budget deficit to a mild surplus. And Portugal was also one of the countries that was outperforming most of its euro area peers in terms of economic growth. Of course, you could still say that is not sufficient to tell us that the risk premia are the right one and the right ones, and therefore we're also now comparing the risk premia with the risk premia of sovereign bonds in other areas of the world. And of course, you have to take account of the credit risk. And what you can see in this graph is that on average, the risk premia of euro area government bonds are relatively close to those of other advanced and major emerging market economies for a given credit rating. So let's now have a look at the price discovery mechanism. So what we're looking at here is how euro area sovereign bond spreads are reacting to macroeconomic surprises that's shown on the left-hand side, or to financial changes in financial market risk on the right-hand side. And here we distinguish three periods. So the period before the financial crisis, let's call it the crisis period, and then the period since 2015. And what we can see is that there was this period, you could say, of complacency, where the sensitivity was extremely low. So this was the pre-global financial crisis period. And we are not close to those levels nowadays, but the sensitivity to macroeconomic factors now is much higher than it was in that time. At the same time, it is, however, lower than what we've seen in this period of 2008 until 2014. But there are actually quite a few arguments for saying that that the sensitivity was excessively high in that period. And also we should take into account that quite a few reforms have taken place since that time. So the ESM has been founded, the SSM has been founded, and so on. So overall, it seems that spreads do react to fundamentals. And you may ask, so why is that the case, even though the ECB is buying so much? And the answer, I think, is in this chart, which shows you the evolution of what is called the bond free float. So that is a share of bonds held by investors other than the central bank, so other than the euro system in our case. And you can see that the free float in the euro area actually currently amounts close to 80%. So 80% of bonds actually held by investors outside of the euro system. And also in the wake of the launch of the PEP, this number has not declined significantly. And the reason is, of course, that as the purchases have increased, also the issuance has been quite quite big. And so that is the reason why markets are still able to price risk. We should, of course, be aware that financial markets are not always doing the right thing. They're not always rational and not always efficient. They can be prone to panic and instability. And in such periods of market stress, it can happen that spreads deviate from economic fundamentals. And in such periods, if they are left unaddressed, it can easily happen that a liquidity crisis turns into a solvency crisis. And in such a situation, it is clear that there is an argument to act for the central bank. I mean, the central bank can not be a lender of last resort to governments, because this is explicitly prohibited by the treaty. But of course, the ECB can, and I think it should, provide liquidity when markets fail to coordinate. And then the intervention of the central bank can ensure that market participants coordinate on the good equilibrium. And this non-fundamental part of the spread then can very quickly disappear. So one example is that shown on the left-hand side is what happened when Mario Draghi gave his famous "whatever it takes" speech, which clearly constituted a coordination device, calmed markets very quickly, and also then bought time for the euro area to implement the badly needed reforms. And I would say what happened in the March of this year is actually quite similar. So again, we've seen how the spreads were divergent, and actually that was, for me, that was quite an exciting time. I was just new in the ECB. We were sitting in front of the Bloomberg terminals, and you could basically see the financial system collapse. And then the announcement of the PEP in March did something very similar, like as the "whatever it takes" speech by Mario Draghi. It calmed markets and thereby facilitated this historical deal at European level to agree on a common European package. And I think this is something that that has to be seen, that that this calming of markets is not just an end in itself, but that it also creates space for for other policymakers to prepare the relevant response. So in such situations that I was describing, moral hazard does not play an important role, and it shouldn't prevent the central bank from acting forcefully. So let me finally come to the change interaction between fiscal and monetary policy, and this of course has to be seen in relation to the broader macroeconomic developments. And so we know that there have been these long macroeconomic trends, and one picture that I always show in these contexts is a picture of the long-term decline of the real equilibrium interest rate, which of course poses challenges for monetary policy because there's now much less conventional monetary policy space than, for example, at the time when the ECB was established. And this downward trend is mostly caused by slowly moving structural factors like demography or the slower productivity growth and so on. And so there's relatively little the ECB can do about that. And in such times, and this has happened, of course, not only in the euro area, but in most parts of the world, I'm tempted to say, central banks have switched to non-standard monetary policy tools. And these tools have proven quite effective, but of course, there is the fear that they go along with adverse side effects, and these side effects may grow over time the longer these instruments are used. And for monetary policy, the main result is that we now have to take into account that there is an effective lower bound on interest rates. And all this then has three important implications. So the first is that fiscal policy has become much more important as a macroeconomic stabilization tool. So in such times, monetary policy by itself may not be sufficient to stabilize the economy. Of course, it can complement fiscal policy, but it will have a hard time to lift the economy out of a low growth and low inflation situation. And in such times, it would certainly be wrong to constrain fiscal policy today in order to protect monetary dominance tomorrow. I actually think it's quite the other way around. So we need, in such times as today, we need active fiscal and structural policies, which may then actually foster central bank independence. And the reason is that these policies, if of course implemented in a sensible way, they may boost potential growth and increase the monetary policy space in the future. The second very important consequence is that fiscal policy not only becomes more important, but also more effective. And this is shown on the right-hand side. So there's by now a wealth of research showing that fiscal multipliers are larger at the effective lower bound. And I mean, the main reason is that normally fiscal stimulus would trigger expectations of monetary tightening, but at the lower bound, investors anticipate that interest rates will stay low for a long time. So the third consequence is that the cost of debt has fallen, and as a result, sorry. And what we see on this graph is the interest rate growth differentials, and you can see how this interest rate growth differential turned negative in recent years. What this of course implies is that in order to keep that sustainability, it's no longer necessary to run primary budget surpluses because the debt ratio will stabilize more or less automatically. And this means that the welfare costs of higher debt are lower now than they were in the past. And this is even more true if the funds are used for productive public investment. And I think for the euro area, there can be no doubt that there are quite a few areas where such public investment is needed and is actually necessary in order to foster potential growth. So the green transition is one area, the digital economy is another. Of course, we cannot take for granted that these financial conditions will exist forever. So as you can also see on this graph, there were periods where R minus G was negative, and there are periods where this is positive. And so I think it would be dangerous to rely on the idea that it will this differential will always remain negative. So of course, the ECB will be very careful not to choke the incipient recovery by initiating a tighter monetary policy prematurely. But of course, there will be a time when the crisis has been overcome and when inflation has returned to a sustained path towards our aim, when the ECB will have to step back again in line with its mandate and in line with a symmetric target, as we already did at the end of 2018, when we decided to end asset purchases, even though not for a very long time. So what that means for the fiscal side is that governments will at some point have to regain fiscal space once the economy has recovered from the crisis. We know that in the past, many countries have not taken advantage even of the good times in order to create policy space for the future. The very relevant question, of course, is then how should this be done? And in principle, there are two ways to do this. One could try to boost potential growth, and one could cut budget deficits. And in my view, actually, both will have a role to play, but there is a clear hierarchy in the sequence. So the governments should give clear priority to first boosting potential growth by directing spending towards productive investment. And there is evidence from the ECB that that this can actually have a huge effect also on growth, on debt dynamics. So as shown in this graph, an increase in potential growth by 1 percentage point would reduce public debt as a share of GDP by more than 10 percentage points in some economies over a 10-year horizon. At some point, there will also be the need for fiscal consolidation, but again, this should reflect the lessons from previous crises and should be done in a growth-friendly way. One aspect that I also find very important is that policymakers should think about how the euro area's fiscal framework can be reformed. Among economists, there is a broad agreement that the fiscal rules are far too complicated and also too pro-cyclical, and there are very good proposals on the table how to do that. And I think this would be urgent for the coming years. We should also be aware that this issuance of joint debt, which of course is a huge step, I think, in the direction of European integration, should also go along with an improved governance structure, because otherwise there is the danger that this will fire back if the funds are not used in a sensible way. And then, of course, for governments, this will be one major challenge. So let me come to the end. So my first claim was that the pandemic has not undermined monetary dominance in the euro area, but that what we have done in the crisis is clearly determined by our price stability mandate. The second point is that our asset purchases and other measures have not muted market discipline, so that the risk premium that we see in euro area sovereign bond markets still reflect fundamental forces, and they're actually quite in line with what we see for the international peers. In times of acute market stress, central banks do have a role to stabilize markets, as we have seen in March of this year. And finally, the secular macroeconomic trends that we have observed have changed the interaction between fiscal and monetary policy. So fiscal policy is now more important, and it is also more effective as a tool of macroeconomic stabilization. So overall, I'm of the opinion that this regime of monetary dominance on which the euro is built has served us pretty well. Of course, you may say that nowadays the threat of inflation is very remote, and I agree, that's certainly true. But nevertheless, all these factors that have motivated to introduce central bank independence, I think, are still relevant today, and therefore I do not think that we should move away from that. Thank you very much. And it was far too long, I'm afraid.
Thank you very much, Isabel. So I think that was a very convincing case that the ECB is not undermining its own independence, rather the opposite. And I quite liked how you phrased that active fiscal policy in this current situation fosters central banks' independence rather than the opposite. Such a sentence will not make you more popular in some parts of the city, as you know well. But I think it is a very important challenge that you pose to fiscal policy makers, and that the priority to growth and investments rather than closing public deficits should be given. I think that would be a bit of a shift in terms of fiscal policy in Europe, which I think is important. I think we have already a couple of people who want to ask questions, and in the interest of time, I think we should collect a few and then give you the opportunity to respond to some of them. We will start with Lorenzo Coronio.
Thank you very much. Thank you for the nice and interesting presentation. And I've seen a graph that shows the multipliers on your presentation. And my question is, if we take mainstream multipliers in the academic literature, even the most conservative ones, you have certainly a non-negligible and actually substantial boost to economic activity in the eurozone due to the next generation EU package. At the same time, you have also a significant impact on the GDP deflator. The boost to the GDP deflator is going to be a temporary effect, but it is certainly a temporary effect that might last for a number of years. So what would be the policy reaction by the ECB in that case?
Thank you very much, Lorenzo. The next one is Martin Sandville from the Financial Times.
Hello, thank you, Isabel, for your customary clarity. I would love to hear your thoughts about the recent change in the Federal Reserve's monetary policy framework, both the shift to average inflation targeting and perhaps in particular the end of a symmetric approach to the natural rate of unemployment. Also how, if at all, this plays into the ECB's own strategic review, which the president said was picking up again now after the pandemic hiatus. Thank you very much.
Thank you, Martin. That almost calls for another presentation of how to evaluate the Fed's policy changes. We have two more. This is Henry Kerr. Please, Henry.
We cannot hear you.
You will be unmuted by our staff.
Hello, you got me now?
We can hear you now. Perfectly, thanks.
Hi, great. So some economists and central bankers have argued that the way to look at asset purchases is as analogous to a shortening of the maturity structure of the consolidated balance sheet of the public sector, and that they're fiscal operations in that sense. And what they do is they increase the public sector's exposure to rising short-term interest rates, because to set monetary policy, the central bank has to pay interest on reserves. So I was wondering if you had a comment on that idea, and whether in a rising rate environment in future, the negative effect of asset purchases on central bank profits might create a risk of fiscal dominance.
Thank you very much. And finally, Markus Rothler from the European Stability Mechanism.
Hello. Yeah, thank you so much for this very clear exposition, and also for your previous speeches in recent months, which really have done a lot to clarify minds. I would be interested if you can say a little bit more about this improved governance structure that you have mentioned that will be needed going forward. I think there is a consensus now that there is, of course, greater correspondence between monetary fiscal policy. There is a need for new fiscal rules under the Stabilization and Growth Pact. The role of debt should change, perhaps from levels to flows. You mentioned more importance for growth. You didn't say anything about asset bubbles and how they might influence your policy setting. In other words, there is, I think, a need to change. There's great confusion about what this will be. What could you say at this point in time about these elements of a new governance structure for Stability and Growth Pact, fiscal policy, and the correspondence between fiscal and monetary policy going forward?
Thank you very much, Marcus. So those were 4 questions to which I think there's a lot to be said.
Yes, exactly. So I will try not to be too long because we don't have so much time. But okay, Lorenzo, thank you very much. As you know, of course, the inflation rate that we are considering is the HICP. So it's not. We are not explicitly looking at the GDP deflator, but your point is actually valid. I will have to think about it a bit more, but we will certainly not react directly to the GDP deflator's developments. On the strategy review, first on the Fed. I mean, normally we do not comment on what other central banks are doing, and I will, of course, stick to that. I mean, so what I can say, of course, is that the Fed has done a very comprehensive review, as we are doing now, and the Fed, of course, is in a very different situation from us. So they have a completely different mandate. And there are many differences, institutional differences, which imply that what is optimal for the Fed is not necessarily optimal for the ECB. Whether this feeds in our strategic review, I mean, of course, it feeds into our strategic review. Of course, we will consider what others are doing, not just in order to learn from what others are doing, but also because what the Fed is doing, of course, does have an impact also what is happening in the euro area on the inflation side, and therefore we have to think about those things. But this thinking is just starting, and so I cannot tell you much about it, but there certainly will be another speech on that at some point. So let's see when that can be. I mean, on Henry's point, I mean, I would always say, I mean, we're not a profit maximizing institution. So I wouldn't worry about this too much. So this is not our objective. We are guided by our price stability objective and not by profit maximization. And if it's true what I said, that the ECB is one of the most independent central banks of the world, then it should work like that. On the ESM, so Markus, thank you very much for your kind words on my previous speeches. I mean, of course, you're the specialist on the governance structures, so you know much more about that than I do. But what I can see is that at the moment, of course, there seems to be a relatively mild governance structure for the EU recovery fund, and I mean that also has to be seen in light of the experience that we've had after the previous crisis, and I'm sure we do not want to return to such a situation. So I think one clear lesson from that time is that countries need to have ownership of the projects that are done. But I would say that it's probably that it would not be great if the let's say the grants from the Next Generation EU were used for a reduction in VAT. I don't think that would be what we all have in mind. And as I said, at some point this will backfire. And I mean, now we have this European movement, let's say, this pro-European movement, and that there is a lot of willingness also to have transfers in the euro area. And I mean, it would be a great pity if at some point there would be the large disappointment because the money has not been used in order to foster potential growth, and the divergences that we're all worried about at the moment persist in spite of that money. I mean, on the fiscal rules, I think the common proposal is to shift from the deficit rules to expenditure rules, and I mean the exact design, of course, is tricky. And then you mentioned a slightly different point, which was on the asset bubbles. And that's, of course, another topic that will feature prominently also in the strategy review, namely the question of side effects of our policies and how should financial stability feed into our monetary policy. So can we just delegate that to macroprudential policies, or do we need some way to introduce financial stability aspects directly into our decision making? But that is again an open question, but that's an important one which I think will have to be discussed.
Thank you very much, Isabel. I think we have time for a few more questions. So if you want to raise your hand, please do. The first one will be from Krishna Gua from Evercore from the United States.
Thank you very much. And thank you, Isabel, for your very insightful presentation. I wanted to ask you about your own personal understanding of the pandemic QE program, PEP. Your colleague Philip Lane has spoken about how this program is to be used to correct the downward shock to the inflation path associated with the COVID shock. And clearly we see from the latest ECB staff projections that while the inflation outlook has improved somewhat as a result of the easing measures that you've taken and also the fiscal support measures authorized by governments, the inflation projection is still well below what it was prior to the COVID shock. So how do you think about the rule or guiding principle for PEPP purchases? And what are the implications if the inflation projections remain far below where they were before COVID hit? Thank you.
Thank you very much. And I wanted to add one question to the idea of the lender of last resort issue. So until 2012, that was cleared out of to what extent the ECB would stand behind government bond markets in times of crisis. And you showed quite clearly that OMT corrected that, or the speech, whatever it takes. But then during the pandemic, we saw again the spikes in spreads, but I think that was well contained by the ECB through very swift and frankly quite aggressive action early on. But to some extent, of course, if Italy's debt, for example, were to end up at 150, 160%, that sustainability questions will come back. And the ECB's role as sort of, you call it not lender of last resort, but market stabilizer, I would still refer to it as lender of last resort. So is that where's sort of the legal political limits to what the ECB can do? This, of course, with the back of my mind is, of course, the German Constitutional Court's challenge to what the ECB can do. The latest episode of that had nothing to do with monetary financing, but the next one may well have, because I'm sure that those who brought the case to the German Constitutional Court will only feel emboldened. So are you concerned about future legal challenges?
Okay, so thank you very much. So first to Krishna's question. So I think we've made pretty clear that the PEPP follows two purposes. So the first is to counter the risk of fragmentation in the euro area, and I think in that respect, really a lot has been achieved. So the spreads have come down quite a bit. The dispersion is now similar to what we've had before the crisis. And then the second is what we typically call the stance element of the PEPP. And there indeed the aim is to close the inflation gap that has been caused by the pandemic. And I think if you look at our inflation outlook, what you see is that the number for 2022, of course, is still pretty low. And that's not a number with which we can be entirely happy. On the other hand, we're also seeing that our measures are having the desired effect. So sometimes it also just takes time for the measures to play out. So it's going in the right direction. There are some counter effects. There's the effect coming through the exchange rate. There is also this effect which actually comes from energy prices. First we have the base effect kicking in, and then the futures curve becomes very flat, which then actually has an effect then on our inflation forecast. So I think what we always made very clear is that our approach is data-driven. The uncertainty at the moment is still exceptionally high. There are all the uncertainties still about the pandemic, about the question how severe the second wave will be, when the vaccine will be there. There's uncertainty about the US elections. There's uncertainty about Brexit. And so there is the need to wait for more information to take informed decisions. So what we're seeing at the moment is that our new projection is very much in line with the projection that we've had in June. And so if it all plays out as we think, then we should be fine. However, we have to see what data is coming in, and then we may have to reconsider depending on what the data bring. And of course, I mean, that's we say the risks are still tilted to the downside, but of course there are also some things that could turn out more positively. I mean, maybe one thing I should mention is that in our forecast, for example, we only take into account those fiscal measures that have already been finally agreed by the national parliaments. And that means that, for example, the next generation EU is not yet contained in the forecast. You should be aware of that. The French package is not yet contained in the forecast. So there are also these there are also things that are a bit on the upside. So and I think this should be seen. And but for the moment, I think it's pretty clear that we should wait for new information. So on Christian's question. So I think you're right. The PEP actually worked nicely. So that it really, so this forceful action in the beginning worked very well. But of course, I mean the ECB is not targeting spreads, and if the fundamental risks go up, of course, there will also be changes in spreads. I mean, this is exactly why the fiscal response is so important, and why, especially, I think the use of the funds from the next generation EU is so incredibly important, because, as I also stressed in this speech, the best way to ensure that sustainability is, of course, to generate growth. And I think there's actually a wide consensus on that. And so it's really an issue of governance, because everybody knows what has to be done. And I think that's also true. I mean, quite a few Italians are listening. I'm sure that most of them would agree that certain reforms should be done. And I think this is now really the time to do that. So I think there clearly are legal limits. So monetary financing is prohibited, and what that then means precisely, of course, is I mean, that's not black and white. On the next case that is coming, I mean, so the next case has already been filed, as you probably know, against the PEP. I mean, I must say I'm not too worried. I mean, some people have argued that. Actually the previous judgment has defined conditions under which asset purchases are considered not to be monetary financing by the German Constitutional Court, but actually all these criteria always have to be context dependent. And I mean, we are in the most severe crisis since a very, very long time. And it's completely obvious, in my view, that we have to take unusual measures in those times. I mean, the program, the PEP in particular, has of course safeguards, and I think one important safeguard is that it's clearly linked to the pandemic. And so, of course, at some point, the Governing Council will have to decide on when the pandemic is over. But of course, I think we would have a problem if the PEP were now running for the next 20 years. And therefore, I do not think that this is going to happen.
Thank you very much. I think we have time for one more question. And I get to, no, Raymond Torres gets to ask it. Okay, Raymond Torres, you go first.
Hello, thank you, Isabel, for your very, very interesting and fascinating presentation, very clear indeed. I have one question concerning, to follow up on your point that countries now have some room for maneuver to, in a way, stimulate the economy, and the monetary conditions are there. So I mean, you made the point several times in the presentation, in the comments. But there are countries at the moment where the fiscal space is perceived to be certainly much more limited than in countries, for example, like Germany, which for for good reasons, did some fiscal effort during the expansionary period, and the other countries didn't. But the fact is that they do have much less room for maneuver. And you're quite right that the next generation EU will be very useful, but in most scenarios, the funds will start to be disbursed as from the middle of next year, and really it will come for true only as from 2022 probably. So there is a big gap here during which it's going to be very difficult for those countries. So to what extent is this something which worries you for monetary policy? Because of course at some point you may have very significant divergences already now happening, and therefore mounting private debts, possibly spreading over the financial system and leading to some particular issues. So what's your assessment of this situation?
Thank you, Raymond. May I just emphasize one point that Raymond raised. We've been talking about the increase in public debt, but of course there is a commensurate increase in private debt, the reckoning of which is yet to come. So at some, is that a big worry inside the ECB that, for example, non-performing loans would increase and then inhibit lending and inhibiting the recovery? I think that was what Raymond meant with the second part. Thank you.
All right, so thank you very much. So I mean, Raymond, you're of course perfectly right. This is exactly the motivation for Next Generation EU, that the fiscal space at national level is in some countries quite limited. And I agree with you also that there could be quite some delay until these funds are actually dispersed. However, so what we are seeing already is that some countries are actually in anticipation of those funds already introducing measures, and in order to enforce that. Of course, the uncertainty about the Next Generation EU should be resolved as soon as possible, because that is the major thing. I mean, as soon as member states know that it's really coming, in which way it's coming, how much is coming, then they can plan on the basis of those funds. I mean, I also think there is a certain advantage of the funds coming later. Which is that many people are now talking about cliff effects, and that is a big worry. And so my hope would be that actually the funds could partly also be used to deal with cliff effects. And there is this very nice phrase from the BIS, I think, which says that what we have to do is we have to turn the cliffs into ramps. So it's not really useful to just postpone the cliffs, because then the cliff will still come. I mean, maybe it comes at a better time, but it's still a cliff. But it's of course much better if we kind of manage the transition in a smoother way. My hope would be that the European funds would help. But I agree with you that the uncertainty about it, that has to be removed very quickly. And then maybe it doesn't matter as much when the funds are actually coming. On Christian's point, private debt clearly is a very very important issue. Again, there's quite a bit of heterogeneity across countries. I think one actually has to distinguish between different types of firms. There are what we've seen in the beginning of this year, directly after the crisis, of course, that the demand for credit was shooting up, and that quite a few firms actually are holding these funds as cash on their balance sheet. So even though debt has increased quite dramatically, the net debt hasn't increased that much. But that being said, there are of course also companies that have a bad outlook and that are maybe still protected by guarantees or by the insolvency rules, which are not working at the moment. And there will be defaults. There will be an increase in NPLs. Of course, this is unavoidable. I mean, we cannot avoid all defaults, and given that there has to be structural change after this crisis, it's clear that there have to be certain defaults. But again, of course, what would be quite dramatic is if there was a point in time when suddenly a lot of firms were going into insolvency. And of course, what we have to avoid in any case is that fundamentally viable firms go into insolvency. So my feeling is that the politicians are quite aware of these problems, and there may actually be the need to do more on some sides. I mean, we also, there were some very interesting proposals that were based on the idea that we should not only have support through loans, but more through equity based structures, which I find completely convincing, but which unfortunately was not really taken up. But overall, I would say like one of the big downside risks probably is that there could be a financial amplification through the banking sector. At the moment, it doesn't look like that, but of course one cannot fully exclude it.
Thank you very much. And this, I think, brings a very interesting hour to a close. What remains to say is to say big thanks to Isabel for coming and for doing this webinar with us. And a big thanks for all of you for tuning in and contributing with your questions. And I hope to see you all at the next CER webinar. Thank you very much.
Thank you very much also from my side. Bye-bye.